So today we have Paul Moore of the Wellings Fund, which is a really unique alternative strategy idea. I'm going to let Paul explain what he does. But before we do, I just want to have my standard disclaimer. I am not your financial advisor. I may or may not have invested with any of the companies that I am doing an interview with. I may or may not have lost my own money with these companies. So please do your own research and understand that any investment that we do, there is risk involved, whether it's on Wall Street or outside of Wall Street, and that this is being shared for your education and entertainment purposes. Having got that out of the way, Paul, thank you for helping me out and being on the call today.
Absolutely. It's great to be here, Howard. Thank you.
Good. Can you just give a little bit of background of your story? I know bits and pieces of it where you've really come, I'm not going to say full circle, but there's definitely been an interesting arc. So I'm going to let you take it.
Yeah. So I sold my company to a publicly traded firm a long time ago, 23 years ago, and moved to Virginia and started flipping houses. And before flipping was even a thing. And then I started buying and selling high-end waterfront lots, built modular construction, did some ground up. And you know, Howard, I was always trying to think, I don't think I knew that the Forbes 400 wealthiest people in the world almost all invested in commercial real estate, but I had a sense that the wealthy people played in that space. I didn't know how to get in. I didn't know who to trust, where I'd get started. But finally in 2011, I was compelled by the lack of housing in North Dakota in the Bakken oil boom. And so my buddy and I quickly built a fairly large multifamily facility there for oil workers. That went really well. And then after working with him on a Hyatt hotel, I jumped into Class B multifamily. I actually worked on that for a number of years. I actually wrote a book on it called The Perfect Investment. But found out that the perfect investment wasn't always perfect if you couldn't find assets that were fairly priced. And I felt like they were overpriced for years. So I expanded into self-storage and mobile home parks a couple of years ago. And so Wellings Capital now has 3 different funds that invest in self-storage, mobile home parks. We're really excited to be in those arenas.
Okay, and so that's really where I want to take the focus now is I'm going to have a different expert in terms of on the multifamily because that's what they're still doing. But I know you are the person in terms of the self-storage and mobile homes. So who is your typical investor now?
So, and just to be clear on that, I still love multifamily and plan to jump back in it. It's just been really difficult the last 5 or 6 years. Yeah, our typical investor is someone who is a high wage earner, someone, who's accredited. They know about the benefits of real estate. They might have tried a few single family homes on the side and found out how really difficult it is if you're not focused fully on something like that. And they want to get the tax benefits, the cash flow, and the appreciation of real estate, but they don't want to do it on their own. Some of these folks actually do real estate, but they're in different sectors and they want to passively invest. And so that our typical investor would be somewhere between 50 and 50,000 and $500,000.
Okay. What do you see as the greatest strength of being in that niche of self-storage and mobile home parks? And I guess you can talk about the strengths of both of them.
Yeah, I just wrote a book on self-storage. It should be out this summer in 2020. One of the things we like best is it's a small part of someone's typical income and financial picture. So if I'm renting an apartment to somebody at $1,000 a month and I raise it by 6%, when they sign that lease, they're signing up for $60 a month or $720 total and then more the next year. But with self-storage, if I'm charging them $100 a month and I raise it 6%, they're probably not going to take a Saturday, rent a U-Haul truck, get their friends together, and to move their stuff down the street to save $6 a month, especially when they're on a month-to-month lease. And most people think, I'm moving next month or a few months anyway. So it's really a great niche to be in as far as tenants being sticky. Once they get in, they typically stay. Self-storage across the board in this current downturn we're seeing in the spring of 2020 has suffered little compared to others. I just watched a Green Street analysis that said it was one of the bright spots in the economy right now, along with manufactured housing or mobile home parks. One of the things I love about mobile home parks is they're the bottom rung on the housing chain for the most part. If people can't afford the cost of a lot or a mobile home park, mobile home lot rent, they typically end up under a bridge, and we don't want to see that happen to anybody. So we invest with operators who are making a better community. They're buying these communities, they're making them nicer, they're improving services and customer service. And typically, again, the cost per square foot is, a fraction of apartments and single family homes. And there is an affordable housing crisis in the US, Howard. There's 10,000 people turning 65 every day. And sadly, 6 in 10 of them have less than $10,000 saved for retirement. But many of them have equity in their homes and they're willing to trade that in for a mobile home park lifestyle. And some of those folks aren't even lower income. They just choose to do that so they can have a nicer car, better vacations, less maintenance, etc. So we love the strategy of buying from mom and pops with a lot of upside in both of these arenas. This allows our operators to pay a fair price to the seller, but still have a significant upside for the buyer and the investors, which translates to a margin of safety in difficult times and high profits in other times.
So, I mean, beautiful explanation in terms of the strengths, but whenever there's strength, there's always,
Yeah.
you always have to see in terms of the risk. So what do you find is the biggest risk of these two asset classes?
Yeah, so self-storage is a month-to-month lease situation. So you can't look down the road for a year and say, this is our occupancy for the next year at a time. It does vary more month to month. Another weakness with self-storage is there's been a lot of new supply come online. So in '08, self-storage in '09 actually took very small hit compared to other asset classes and recovered very quickly. But this time in 2020, there's a lot more supply. And it's always hyper local. So, I mean, I'm always looking at a 3 or 4 mile radius. So I could tell you, for example, Howard, that Nashville is oversupplied, but I could also take you to Bellevue and Belleville on the south side of town and say they're very much undersupplied. And there are other places like in Ramsey, north of Minneapolis suburb of Ramsey that has virtually no supply. And so there are perfect places to build self-storage, but there are other places that are oversupplied, like I mentioned. Mobile home parks, I feel like there's a risk of tenants not being able to pay their rent in a severe downturn. So far, where we are in 2020, we've not seen that to be the case. In fact, we're seeing growing waiting lists to get into mobile home parks. But we're talking about people here. We're talking about families. And unlike self-storage, which is very easy to evict or at least make sure people pay by the 5th day they're late, with mobile home parks, there are pretty strict anti-eviction laws in certain states all the time, or at least restraint on evictions. And I think that is something we need to be really cognizant of. Self-storage, while there's a chance of being oversupplied, mobile home parks are decreasing in supply every single year. And so that's not a risk there. But we do believe that there's going to continue to be a need for mobile home parks. I will say it's really hard to fill vacant spots because think about it, you have to find a tenant that brings their home with them.
Mm.
Or you've got to put a home on the lot, like get a used home, refurbish it, Maybe you'll have 10 or $20,000 in that, which a lot of mom and pops don't like to do at all, by the way. And then you have to rent it out to a tenant buyer, somebody who's going to, commit to buying that home typically. So that's a downside for the mobile home park business. It's a little harder. It's not like apartments where you can fill 5 spaces in a week.
Okay, thank you. So I know what you and Wellings Fund does is a little bit different. We're not talking, and so I'm delving just in terms of your specific situation. I want people to think in terms of like a mutual fund that there could be a manager that will pick, Apple and Microsoft and Tesla. And not only are they betting on the company, they're betting on the CEO of Elon Musk or Jeff Bezos of Amazon, that their leadership and their conviction is going to help drive the price of that stock and the company value higher. You guys do a similar model where you're looking at not only the jockey and then their execution, correct?
Right. When we got into this, we thought we were really close to the end of the cycle. And we noticed that with crowdfunding and the explosion in interest in syndicated real estate, it's very easy for people to invest. Very easy can sometimes translate to bad decisions, just like we all know we've seen on Wall Street, people making, where 93%, I think, of people who actively trade are losing money. Well, we found it was easier to get in here too. And we thought, boy, there's a real lack of vetting, really sincere, deep down qualification of these operators. So we decided to be the folks who would not be operating these ourselves, but we would find the very best in class operators we could in every asset class we invest in. And we become very familiar with them. We vet them carefully before we invest. And then we look at the deals secondarily to the jockey, in your terminology. And so that's what we do. So we're providing for our investors a very significant amount of vetting that they don't have the ability or the time to do on their own typically.
Okay. And so with that, I'll call it that second layer of due diligence. I'm going to ask this as a tax question. And even though neither of us are CPAs and we're not here giving tax advice, the way you have things set up, do people still get tax advantages by going through your fund?
Great question. One of the most important things about real estate is the getting the K1, the tax return that allows all of the deductions, losses, et cetera, to flow through to the individual investor. And that's exactly what happens with us.
Okay, excellent. What's a typical timeline that people are, whether your operators are purchasing them or just, general operator X, they're purchasing a mobile home park, self-storage. What's a typical timeline that they're holding the asset on for?
Well, one of the things we love about our fund is the diversification across asset types, geographies, operators, assets, but also across strategy. We like to see some diversification across that. So we have some operators whose strategy is to get in year one, make significant changes to improve the operations. In year two, experience the fruit of the increased net operating income. And then in year three, sometimes refinance, but usually sell the asset for a greatly increased price, which drives a very high internal rate of return because of the short hold time and the high profit. So that's one of our strategies. We have other operators whose, like Warren Buffett, their preferred hold time is forever. And so because of that, and because of the fact that we don't know what the economy, which means interest rates, cap rates, supply, demand, will look like when we go to sell an asset in 5 to 7 years, we bake in a 10-year hold time for our funds just in case.
Okay. So if someone's investing with you, they should expect that that money is quote unquote gone, not accessible for 10 years.
Right. And we consider that a liquidity tax or a liquidity penalty, if you will. It's, our assets, investing with us is not real liquid. Now, if you look at Buffett like we do, he says, that's what you want to do anyway, as the best investors hold for a long time anyway.
Yeah. You already mentioned you work with accredited investors only. What's a minimum investment with your company?
It's $50,000.
Okay. And can one only invest with after-tax money, or could they do it with the self-directed IRA funds as well?
Great question. Yeah, a lot of our investors invest with self-directed IRA, solo 401ks, or after-tax money as well. Now, there's also a question you might ask is, what about people with a 1031 exchange who are trying to kick the can down the road on capital gains? We're setting up a new fund, which is going to be just for people who want fractionally to own who have a 1031 exchange and want to own the interest in this real estate fractionally and preserve their 1031 exchange.
Got it. And although past performance is no guarantee of future results, can you give people kind of a range in terms of what returns should be? I don't know if you want to split it between mobile
Yeah.
homes and what the range, what investment returns have been in the past for that, and then self-storage and what, and I guess if you just want to pitch your,
Yeah.
pitch your own fund, how things have come out.
Sure. Yeah, so we're expecting about an 8%, they call it a cash on cash return. I prefer to say a cash flow from operations return, and that is cash on cash, but we're expecting about an 8% return average. We expect it to start at 5 or 6% the first few years, 7 or 8% the next few years, and then 8% or more. And then we expect to refinance on the assets we hold, significant refinance, a return of principal to the investors, say in year 4, 5, 6, and then a little lower cash on cash after that. And then we expect at the end of the day to have an additional 7 or 8% from appreciation, Howard. So we expect the total annual return from our funds to be around 15%. And that holds true for self-storage and mobile home parks.
Okay. So to just kind of break this down, there's really kind of three pieces to this if someone's listening. First is if you're thinking of stocks and those that pay dividends, you're talking the yield year in, year out,
Yeah.
anywhere from 5 to 8%, depending upon the life cycle of when you acquire the property and how mature it is.
Mm-hmm.
Then part two is now that the asset has gone up in price, you're refinancing, you're actually getting investors' money back to them. So now they're like holding this asset for free because they got their money, their principal back. And then at some point in the future, it then sells, and there's the next liquid event. And so adding all three components together, you've seen roughly 14, 15% a year when you look at all three pieces, average it out over 10 years. Is that a reasonable way to
Yes.
talk about it?
Yeah, that's what we're projecting. That's right. And that doesn't include the possibility that on some of those short holds, let's say we have an asset for 3 years. If we have 7 years left in the fund, we may flip that money back, and try to turn it again in 3 or 4 more years. So that would be a nice bonus. But of course, there's no guarantee we'll be able to do that.
Right. Okay. Paul, any final words?
Um, I would just encourage people to really listen to what you're saying. You and I talked at length a few days ago, and I know what you're doing here. And I would really encourage people to listen because it's so tempting to chase shiny objects. It's so fun to try to pick the next Google or Facebook or startup. But honestly, the odds of getting wealthy that way are so incredibly thin. I like to talk about it in terms of investing versus speculating. Investing is when your principal is generally safe, Howard, and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. I feel like investing, Warren Buffett was asked by somebody, said, why doesn't everybody just follow you? It's Mark Zuckerberg asked him, he said, your strategy is not that hard to follow. Why doesn't everybody do that? Warren Buffett said, no, no, no. People don't want to get wealthy that slowly. Well, I think if we all followed in Buffett's footsteps, we'd be doing pretty well. But he really, really invests. You know, he's not chasing some speculative thing that may, give him 10x back or may go to zero, like dropping money to the bottom of an oil well, like I did in 2010, and seeing zero results. The long-term best way to invest is to look at it sort of like Buffett or Benjamin Graham, who talk about value investing. You can value invest in real estate or in other areas, but that's where I really encourage people to put their focus.
Paul, what's the best way to reach you?
You can reach me